In this short clip, I want to go over chapter 4 homework on merchandisers. I want to do number 29, 30, and 31. Hopefully, I'll give everybody some tips on how to complete this. So, on number 29, it says, on November 1st, Chilton Systems purchases merchandise for $1,500 on credit with terms of 205 and a 30 FOB shipping point, invoice dated November 1st. So what we're going to do here, I'm going to make T accounts here. I'm not going to do the journal transactions. So hopefully by this time you know what you're doing with T accounts. So we're going to make a T account for merchandise inventory or just inventory. And that's going to be a debit for $1,500, and then we're going to do a credit for accounts payable. So accounts payable, and we'll do a credit for $1,500. Now I will say something here. I like to, and I'm gonna put letters here. So I like to every now and then put like an A beside or 1 beside my stuff, just so I know, oh, these two go together, these two transactions go together. So let me keep on going. On November 5, Chilton Systems pays cash for November 1st purchase. So, okay, now they pay cash. So I need to go back to the November 1st one, and I see that the terms of 2 of 10 and 2 of 5 N of 30. 205, or it looks like this: 205 N of 30. So that really means that the company gets a 2% discount if they pay within 5 days. They paid on the 5th, so they definitely get the discount. So what I need to do is give them. So they paid off their accounts receivable. So their accounts payable. I'm sorry. So I'm going to put their accounts payable here. And they got a 2% discount. Now, differences between perpetual and periodic inventory. In the perpetual inventory, we put that discount in immediately. On the periodic, we will wait. So because we put that discount immediately in, it's a 2% of $1,500, which is $30. So I'm going to put the $30 here. And then we need to also credit cash for the remainder, which is $1,470. That's the amount they paid. So let's go to the next one. The next one says that on November 7th, Chilton Systems discovers and returns $200 of defective merchandise purchase November 1st for a cash refund. Now, remember, we're still on perpetual inventory systems. So therefore, when we return that $196 of defective inventory, we need to debit the cash, credit the merchandise inventory. But now here's the but. The company got a discount for this purchase. It was a 2% discount. So they didn't actually pay $200 for the merchandise. They paid $196 for the $200 worth of merchandise they're returning. So with that, we do not give them a $200 debit to cash and a $200 credit to merchandise inventory. We're going to do the $200 minus the discount, so they get a $196 debit to cash and $196 credit to their inventory. So the next one. On November 10th, Chilton Systems pays $90 cash for transportation costs with November 1st purchase. Now, they are on what's called FOB shipping point. FOB shipping point means that they have to pay for the shipping. They are also on perpetual, so this shipping cost goes directly into the merchandise inventory. So when they pay the shipping, we're going to debit merchandise inventory for the amount of shipping, which is $90, and we're going to credit the cash for that amount. On November 13th, Chilton Systems sells merchandise for $1,600 on credit, and the cost of the merchandise is $800. Now, remember, we're doing this on perpetual inventory, perpetual system. So when you make a sale, you need to make a adjustment to the revenue as well as an adjustment to the inventory at the time of the sale. Now, they sold it for $1,600. So when they sold it on credit, on account. So we're going to debit their accounts receivable account for the $1,600 that they sold it for. And we are going to credit their sales account for the $1,600. Now, that's the revenue side. Now we need to make the adjustment to the inventory. As the question states, they had a cost of goods sold, cost of merchandise sold of $800. So we're going to credit their merchandise inventory for the $800, and we're also going to debit an account called cost of goods sold for $800. So finally, we have on November 16th, the customer returns the merchandise from November 13th transaction. Returned items would sell for $300, and they did cost $130. The items were not damaged and were returned to inventory. Now, remember again, this is perpetual system. So we're going to make an adjustment to inventory as well as an adjustment to the revenue. So the adjustment to the revenue is going to be this account, and I'm going to just make some space over here. And it's actually called sales, returns, and allowances. And so we're going to credit that account for the return, and we're going to debit made a mistake here. We're actually going to not credit that account. We're going to debit the sales allowances account, and we're going to credit the accounts receivable. That's first. So that's for revenue. The second thing we're going to do is we're going to debit the merchandise inventory account and credit the cost of goods account for the cost of the good, not for the price we sold it. So, all right, this is number 28 on your homework, chapter 4 homework, and this is the perpetual side. I will show you a video. I'll make another video for the shortly on about the periodic side.